Good morning, welcome to CATEX TV. My name is Frank Fortunato. Today is Friday, June 7th, 2013. Chinese President Xi Jinping has arrived in the United States after meandering around the Caribbean for a few days. He's going to be meeting this weekend with American President Barack Obama. It's going to be an informal summit held at a palatial desert estate east of Los Angeles, formerly owned by the Annenbergs. It's intended to focus on trade relations, growing concerns about cyber attacks, and the question of how to deal with North Korea. Meanwhile, in Ghana, of all places, on the west coast of Africa, the Ghanaian government has arrested 161 Chinese citizens over allegations of illegal gold mining and immigration issues. The Ghanaians claim that the Chinese are involved in illegal gold mining. Ghana makes approximately $5 billion a year in gold mining exports. So this is a very serious issue for them. Another serious issue in the United States right now is the first named storm of the year, Tropical Storm Andrea. Barreling up the East Coast as of this morning about 2 hours ago. It was located off the coast of Savannah, Georgia. It's moving at 28 miles per hour. It has winds of only about 40 miles per hour. But boy, is it a rainmaker. Right now, the bands of rain are extending slightly north of Baltimore. The New York metropolitan area is expected, for example, to see as much as 5 inches of rain beginning sometime later this afternoon, running through Saturday night. So heavy flooding is expected here and there. Well, we finally have been seeing some pushback now from the reinsurance industry. Yesterday in New York at a Standard & Poor's conference, Tad Montrose, the president of Gen Re, said that pension funds that increase bets on cat bonds to improve investment returns may flee the market after a major disaster. He said he wasn't surprised that pension funds were investing in cat bonds simply because of the interest rates in comparison to the interest rates everywhere else. But he said, what's going to happen after a $150 billion earthquake when Nevada is basically the coastline to the Pacific? The whole issue that it's a non-correlated asset class, which makes it so attractive as people look at their risk-return profiles, is really an issue that needs to be thought about very, very carefully. Boy, is he correct. He went on to say that the news sources of funds are relying too heavily on cat models in making their decisions about prices. He said reinsurers and insurers use data and simulation from third-party companies to help assess risk. Montrose said that the models have, quote, lent an aura of credibility, but anyone who's in the industry knows that the models are always wrong. Directionally, they're helpful, but we are trying to price a risk today that we do not know the cost of. Well, good for Tad Montrose. It's good that somebody finally said the emperor doesn't have any new clothes. Meanwhile, a continuing battle between Chicago's Aon and Lloyd's of London. It seems that a little bit of a thaw has occurred. An exchange of letters between Aon's group president Steve McGill and the Lloyd's chief executive officer Richard Ward indicate that things might be defrosting somewhat. Apparently, the original Aon initiative, which would have seen Berkshire Hathaway assume 7.5% of Aon's business that has Lloyd's participation, is beginning to be proven correct, at least from Aon's view, as to the benefits that it would bring to Lloyd's. According to the letter from McGill to Ward, client reaction to Sidecar, which is what McGill is calling it, has been very encouraging, which has given our broking team the chance to profile not only Berkshire Hathaway, but also the strength and capabilities of the London market and Lloyd's in particular. A considerable number of placements are already benefiting from increased orders to London and Lloyd's. Of course, the big concern about this deal was from smaller Lloyd's operators who rely on following business for their bread and butter. Ward responded saying that the still big question marks here over the so-called oversight of risks being written by the sidecar. He said, we remain concerned that these types of arrangements put distance between the capital on the one hand and the risk transfer transaction on the other. One of the reasons the insurance market has remained robust has been because the capital has remained close to the underlying business. Not so this time. Well, you may remember that big forest fire in 2004 in the El Dorado National Forest down in California. It caused about 18,000 acres were scorched. Well, the California utility Pacific Gas and Electric was fined $50 million yesterday to settle accusations that it was responsible for the cause of those fires. Apparently, an investigation said that the fire was begun by the tossing of a lit cigarette traced to a crew working around a Pacific Gas and Electric distribution line. Well, Pg&E's had a tough couple of weeks, months. They also were responsible, of course, for the San Bruno gas explosion just south of San Francisco. Can you imagine that? A $50 million fine for a lineman throwing a tossed cigarette, but who should throw a tossed cigarette in a wildfire area anyway? That's the news for today. Last night, the the San Antonio Spurs beat the Miami Heat in Game 1 of the NBA Finals. If we have any breaking news, we'll come back and tell you. Thank you for watching. Have a good weekend. We'll see you Monday.